Welcome to a new finance story. In today's video, we are giving you a clear guide to the top investment opportunities for the year ahead. Now, before we get to the specific stocks, it's important to know how we picked them. We didn't just pick names out of a hat. We used a careful data-based process to find stocks that are not only promising but also strong enough to handle tough times. We went through 16 different Diwali reports from top brokerage firms like Geojit, SBI Caps, PL Capital, Axis Direct, and Prabhudas Liladhar. In total, these reports mentioned over 120 different stocks. However, we used three strict rules to narrow down the list. First, a stock had to be recommended by at least two different brokerage firms. This shows that more than one group of experts likes the stock. Second, each stock needed a clear 12-month price target. This tells us how much the experts think the stock could go up in the next year. Finally, and most importantly, we focused on companies with healthy finances. This means they have low debt, good cash flow, and enough money to survive any unexpected economic problems. Using these three rules, we cut the list from 120 stocks down to just 7. These are the companies we believe are worth your serious consideration. Let's count them down, starting with number 7.
Our 7th stock pick, which might not sound exciting at first, is DOMS Industries. Now, some might think stationery is a sleepy sector. It's not a flashy area like tech or electric cars. However, that view changes when you look at a key government decision. Last quarter, the government cut the GST on items like pencils and colors from 18% down to 12%. This tax cut is a direct boost for companies in this business. DOMS Industries is in a great spot to benefit from this. It has a huge 22% market share in the organized stationery market. This shows it has a strong brand and a good position in the market. On top of that, its operating margin is an amazing 40%. To give you an idea, that's a profit level many big tech companies would love to have. It shows how efficient the company is. Besides the growth, the company has great financials. It has zero debt on its books, which is very rare and provides a lot of stability. It also pays a nice 4% dividend. When you put it all together, a market leader getting a boost from tax cuts, amazing profits, a clean balance sheet and a good dividend, you're getting a solid consumer company that is trading at a great price.
Moving on to our 6th pick, we look at the healthcare sector, specifically Rainbow Children's Medicare. While healthcare is generally a safe bet, even when the economy is shaky, Rainbow is in a very attractive part of healthcare, super specialty care for children. This area is growing fast, about 1.6 times faster than the country's economy. This means there is strong demand for quality children's healthcare. Rainbow's business strategy is very smart. It uses an asset-light model, meaning it leases most of its hospitals instead of buying them. This keeps costs down, gives it more flexibility, and leads to a high return on capital employed, ROCE of 29%. The company also has a program to reach patients in rural areas. This is important because it connects them to the government's Rs 5 lakh health insurance plan, helping more people get care. The extra good news here is the amazing rebound in how full their hospitals are. Over the last 6 months, occupancy has jumped from 48% to a much healthier 65%. This is because more people are coming in for planned surgeries and regular appointments again, showing strong demand for their specialized services. This mix of a high-growth field, a smart business model, government support and strong recovery makes Rainbow a great investment opportunity.
Our 5th stock pick is in the technology sector, an area that hasn't been very popular lately. We are talking about Infosys. But that's exactly why we find it interesting. When a good sector is down, it can be a great time to buy. The best deals often appear when a great company's stock is not doing well, giving smart investors a chance to buy at a lower price. Right now, Infosys is trading at about 19 times its expected future earnings. That's a 25% discount compared to its average valuation over the last 5 years. This discount suggests that most of the bad news is already factored into the price, which gives investors a safety net. Also, its operating margins are stable at a healthy 21%, showing it's managing costs well. In addition, the company is also buying back its own shares, which is a sign that management believes the stock is undervalued. A big driver for future growth is also clear. Its orders related to artificial intelligence doubled in just the last 3 months.
This shows it is well placed to earn money from new technologies. Firms like Geojit are calling Infosys a contrarian buy, meaning it's a good investment that goes against the current market trend. And history backs this up. Our analysis shows a clear pattern. Every single time the stock's valuation has dropped below 20 times earnings, it has returned an average of 28% over the next year. This suggests that the current price is a very attractive entry point for investors.
Now, before we continue our countdown, a quick but important note. If you are finding this analysis helpful and getting good ideas, we encourage you to tap that subscribe button. It's free for you, and by subscribing, you help us keep making detailed videos like this one for everyone without charging for them. Your support helps our mission. We also invite you to join the conversation. Drop a comment below and tell us which stock you think will do great this Diwali. Explain why you think so. We'll carefully review all the comments and will feature the best answer in our next video. Your ideas are valuable to our community.
Our fourth stock pick is a key company in the everyday consumer goods or FMCG sector, Hindustan Unilever or HUL. While HUL is a popular stock, the reason to invest in it now is because spending in rural India is picking up fast. This isn't just a guess. It's happening because of real economic changes. A key sign is that the government has bought more crops from farmers, and the payments they received are 18% higher than last year. This extra money in the hands of rural families means they have more to spend on daily items from small shampoo packets to soaps. This is a powerful driver for companies with a strong presence in rural areas. We are already seeing the results. HUL's sales volumes, a key number for FMCG companies, grew by a healthy 7% last quarter. This shows that consumer demand is bouncing back. On top of that, the company's management has also suggested they might cut prices again. This could encourage even more people to buy their products and help them gain market share. With a strong brand, growing rural demand, and improving sales, HUL looks very well positioned for the year ahead.
Our third stock pick is in the commercial vehicle sector, which is known for its big ups and downs. However, the story for Ashok Leyland looks very strong right now. The demand for new trucks to replace old ones after COVID has lasted much longer than anyone expected. This is providing a strong base for truck makers. Ashok Leyland's future looks clear. They have orders for 11,000 new trucks like LNG and electric models. To put that in perspective, that single order book is equal to 3 months of their total sales. Such a large order book for new types of trucks shows the company is well positioned for the future. For Ashok Leyland, for every 5% increase in sales, their profit margin grows by an impressive 1.8%. This means that even small increases in demand can lead to much bigger profit growth, making it a very attractive investment as the demand for trucks remains strong.
Moving to our second topic, we return to the financial sector, focusing on HDFC Bank. For a while, people were worried about HDFC Bank's merger. We can now say those problems are in the past, and the bank is showing strong momentum once again. The key numbers look very good. Deposits are growing strongly again, up 20%. This is vital for the bank to be able to lend more money. At the same time, the CASA ratio, which is the share of low-cost deposits, is solid at 44%. This is important because it helps the bank make more profit on its loans. Also, the bank is managing risk well, with credit costs expected to be a low 1.2%. All this puts the bank on track for an excellent 18% ROE by 2026, which is a strong sign of value for long-term investors. On top of that, you get the peace of mind that comes with owning India's biggest private bank. But what makes this really interesting is the price. Getting a market leader at such a valuation, especially when its business is improving, presents a major long-term opportunity.
And now, for our number one stock pick, we look to the public sector banking space, the State Bank of India, or SBI. We have a saying for SBI right now, the elephant is dancing. It means this huge traditionally slow company is now moving fast and growing quickly thanks to major improvements. SBI is showing great strength in its core business. Its loans are growing at 16% per year, which shows strong demand across the economy, complemented by healthy deposit growth of 12%. Most importantly, The quality of its loans, which used to be a concern for public sector banks, has improved dramatically. The rate of new bad loans, or slippages, is at a 10-year low of just 0.6%. This shows great risk management. From a price perspective, SBI is a fantastic deal. It's trading at just 1.1 times its adjusted book value. At this price, you are basically getting India's biggest bank, the one most tied to the country's growth, for a bargain price. This gives investors a big margin of safety. All of that is why SBI is our top pick.
Before we wrap up, a quick note on our honorable mentions. These are strong companies that almost made a top 7 list. They just missed out because we felt our top picks offered a slightly better balance of risk and potential reward. These companies, including Axis Bank, Maruti Suzuki, Hero MotoCorp, Tata Consumer Products, ITC, Hindustan Aeronautics Limited or HAL, and Indian Bank, were all recommended by at least 2 different brokerage firms. They have solid businesses and good growth stories. So if you want to invest in a few more companies for diversification or do more research on your own, these are great names to look at.
Now that we have shared our top picks, let's talk about the strategy for investing. It's important to know that investing around Diwali isn't about gambling. It's about understanding that this is often a time when market trends shift. History shows a clear pattern. On average, the Nifty 50 makes 70% of its yearly gains in the 6 months between November and April. This seasonal strength gives investors a great opportunity. While SIPs are a great long-term strategy, being a bit more active during this 6-month window can lead to better returns. Our research shows that putting an extra 10% of your investment into consumer and financial stocks during these months has beaten the market in 8 of the last 10 years. Also, we recommend you plan to hold these stocks for at least 12 months. This gives the company's performance and the stock prices time to grow, protecting you from short-term ups and downs. We also suggest buying more if the stock price drops. Use any dip of 5% or more as a chance to add to your investment at a better price. And finally, in the spirit of Diwali, it's wise to protect your investment. Consider putting about 5% of your portfolio into a gold ETF. Gold often goes up when the stock market goes down, so it acts as a good safety net. This balanced approach helps you aim for growth while protecting your money.
In conclusion, friends, let's remember a basic rule. Quiet markets with low returns don't last forever. They're usually the calm before the storm, and the festival season is often the spark that gets things going again. The list of stocks we shared today wasn't just a random collection. It was the result of very careful analysis. We focused on 3 key things: government policies that help certain sectors, reasonable prices that make them good buys, and strong profit growth that shows the businesses are doing well. From the surprisingly strong DOMS industries to the powerful dancing elephant, State Bank of India, these 7 stocks are a diverse group that work well together. As a whole, they offer a potential upside of around 22%. We believe the selection of stocks could make Samvat 2082 a great year for your portfolio, a year where you finally see some real fireworks in your returns. We wish you happy investing and a very happy Diwali. We hope your wealth grows and shines brightly, just like the Diwali sky. This has been our detailed outlook for you. Finally, let's hear from you. If this video helped you find your next big winner, please hit that like button. Your feedback is very important to us. And consider sharing this video with a friend who still thinks fixed deposits are better than stocks. A data-backed view might just change their mind. And critically, make sure you subscribe and hit the notification bell so you don't miss our media review, where we'll check in on these stocks. Until next time, stay invested, stay disciplined, and stay blessed. This has been your host signing off.